We're here to help you cut through the noise and get straight to the insights from complex financial analyses. Today, we're looking at a really interesting flash event. It's a momentary panic in a stock that's been flying high. And it's a perfect case study, really, in telling the difference between a technical hiccup and a real fundamental problem. We are diving into ONDS Holdings, Inc., ticker ONDS, which just gave us a textbook example of volatility. So here's the paradox you need to get your head around. ONDS got slammed. I mean, it dropped over 5% during the regular session, closing at $12.18. And that, just set off a wave of selling pressure. But then almost as soon as the bell rang, the analytical buyers, they just stepped right in. In the after-hours session, the price snapped right back up to $12.63. That kind of rapid reversal, it just begs for an explanation. Our mission today is to unpack the source material here and understand what exactly scared the market into that dip. And why was the conviction so strong that big money rushed in to buy it back instantly? Let's start with the panic itself. What was the trigger? What one piece of information caused a 5% sell-off with no, corresponding bad news about the business?
It was a classic case of the machines overreacting. The drop was almost entirely due to paperwork, specifically a prospectus supplement filed under Form 424B3. It had nothing to do with business operations at all.
That just seems wild, a 5% drop in a high-growth name, and it's all because of a compliance filing. What did this 424B3, what did it actually say that made the algorithms just hit sell?
Well, the document was filed to register about 2.4 million shares for resale. Now, to a high-speed trading bot that's just programmed to flag keywords, 2.4 million shares plus resale.
Dilution.
Exactly. It instantly translates to dilution risk or secondary offering. The fear is that the company is about to flood the market with new stock. And that fear drove the first wave of selling. But, and this is where the real analysis comes in, the filing represented absolutely no new dilution. That's the key.
Okay, so these weren't new shares being printed to raise money.
Not at all. These were shares that had already been issued months ago. They were part of previous exchange agreements, probably from a financing round they did back in late 2025.
So this was just housekeeping. It's a compliance step. The company was just registering existing shares so that those owners could, have the ability to sell them later if they wanted to.
Precisely. It was required regulatory housekeeping. But the timing of the filing is what likely caused the issue.
Right. Filing that during the trading day when the automated systems are scanning for these things?
It's a decision that management must have understood carried some risk. They had to know it could cause a dip.
So that's an interesting point on management. If this was so harmless, why file it during market hours and expose the stock to that volatility? Doesn't that sort of suggest they were okay with the technical panic?
They certainly accepted the risk, and that's a data point you have to note. The analysts covering this, they argue that while the timing wasn't great, the fundamentals behind the filing were benign. And look, the selling pushed the price right down to that key psychological $12 support level. And technically, the momentum was still intact above $11.50.
And the bounce back confirms it.
What's fascinating here is that the quick, strong bounce in after-hours trading proves the thesis. It shows that human investors were watching, reading the details, and they realized that $12.18 was an unwarranted discount based on fear, not on fact.
So they used the technical sell-off as a buying opportunity.
An immediate entry point, exactly.
Okay, so that distinction, the noise of a filing versus the signal of the business, that's everything. The price snapped back because the underlying conviction is still there. So let's pivot. What is that strong conviction? Here's where it gets really interesting. We're talking about a massive growth story projected for 2026. What are the core numbers here?
You really have to anchor everything on the revenue ramp. I mean, it's exponential. The company is guiding for, roughly $36 million for 2025 in estimated revenue. That's the baseline. But the projection for 2026, it just explodes to over $110 million.
Wait, say that again, from $36 million to over $110 million?
That's the projection.
That's nearly 200% year-over-year growth. I mean, that's a hyper growth rate. That completely changes how you value a company.
Absolutely. And the market isn't trading ONDS on 2025 numbers. It is fully pricing in that 200% acceleration. And the reason they can even project that kind of growth comes from a huge strategic overhaul. The company has officially pivoted and rebranded to ONDS Autonomous Systems.
And that's not just a name change, is it? It's a signal. They're moving away from their legacy business into something with a much higher multiple.
Precisely. It's a deliberate repositioning. They want to be seen as a pure play on the drone economy and, critically, on defense AI. They aren't just a radio company anymore. They're focused on high-margin autonomous platforms, specifically their flagship offering, the Optimus system.
We've heard that name, the Optimus system. For anyone who isn't familiar, what does it actually do that makes it so central to this defense AI story?
The Optimus system is essentially an autonomous aerial inspection and monitoring platform. Think of drones, But with a lot of AI and advanced sensors built in, they're deployed on critical infrastructure, major rail lines, utilities, and now increasingly for defense applications. It allows for predictive maintenance, high-res surveillance, all without a human in the loop.
And that's what government and defense clients want: automation, predictive capability.
Exactly. And that kind of high-value recurring revenue is why the market is willing to tolerate the current valuation.
Okay, let's talk about that valuation, because that's the hard part for a lot of people. The market cap is around $4 billion. Set that against $36 million in 2025 revenue, and it looks, well, incredibly rich.
It does, but you have to look at multiples in context of the new sector. If you look at that $4 billion against the projected $110 million in 2026 revenue.
So you're using the forward numbers.
You have to. You're looking at a forward price-to-sales ratio closer to 36. Now, yes, that is still a premium. But if you look at successful pure-play defense AI companies, especially ones landing big government contracts, they often trade north of 40 times forward sales in their hyper-growth phase. The analysis argues the valuation is baking in two things. First, that they're going to secure large recurring defense and rail contracts. And second, that they can sustain this growth past 2026.
And they have the money to do it.
They do. They have a strong cash position after raising capital in late 2025. So that gives them the funding runway to actually execute this plan without, immediate cash concerns.
So those wild swings, that 5% drop we saw, it's basically the price of admission, as the report puts it, for owning a potential leader here. So now that we get the growth thesis, let's talk timing, because there's a big event coming up. You need to circle January 16th, 2026 on your calendar. That's the date for their investor day. This is where management is expected to lay out all the details of their core plus strategic growth plan.
And historically, high-growth stocks, they tend to run up into these big events. Anticipation builds. This isn't just another presentation. It's the moment they have to validate that $110 million projection.
So what's the best case scenario for that day?
The best case involves them announcing new major defense contracts that specifically mention the Optimus system. That would prove the pivot is working. Even better, they might raise the guidance. If contract flow is better than they expected, they could raise that 110 million figure even higher, and that would send the stock flying. If we connect this to the bigger picture, the analysts are looking for the stock to break $13 this week. If that investor day delivers, price targets quickly move into the $15 range, maybe higher.
That's obviously the bull case. But we have to have balance. A stock that's run up 700% and is projecting 200% growth, that comes with enormous risk. What are the caution flags here?
The first one, and you just can't ignore it, is the volatility itself. The analysis labels ONDS a high beta stock. The beta is over 2.0. That's highly unusual.
Which means even on a quiet day for the overall market, ONDS could swing 5 or 10%. That makes your timing for getting in or out incredibly difficult.
Exactly. You have to go in expecting 5 to 10% daily swings. That's normal for this stock, not an anomaly. Any bad news, even minor, will get amplified. The second risk is maybe a bit more nuanced. It's the optics around the recent insider selling. The report specifically flags that the CEO, Eric Brock, and other insiders have been selling shares.
Okay, insider selling, especially from the CEO, that always raises a red flag. The fundamental story could be amazing, but that creates a bit of a trust issue, doesn't it?
It's the most critical question, really. On one hand, the report puts it in context. The stock ran up over 700%. After gains like that, you expect executives to take some profits for diversification, for taxes. It's common.
But the timing?
The timing is terrible from a confidence standpoint. Selling shares right before the biggest announcement of the year, the Jan 16 Investor Day. It just sends a questionable signal.
It's something you have to watch closely.
You do. Because while the report might frame it as typical, it's still a sign that leadership is taking money off the table right before they ask the public to buy in.
Yeah.
If that Investor Day underwhelms, those sales are going to look very, very bad in retrospect.
So we've covered the technical noise, the hyper-growth signal from the rebrand, and these critical risks, the high beta and the insider selling. So what does this all mean for you? The core conclusion from the analysis report is pretty clear. That recent 5% dip was noise. It was a short-lived panic over a misunderstood SEC filing. The long-term trend, however, remains bullish because of that massive growth story.
It was a clear technical sell-off. Algos reacting blindly to that form, and the quick recovery to over 1260 confirms that the buying momentum is absolutely intact. It was not a fundamental failure. This raises an important question you should ask yourself. In these sectors that demand such huge premiums based on future potential, how do you weigh a temporary market panic against a 200% growth forecast? Your ability to filter that information, to ignore the momentary chaos, that's the difference between selling at the low and positioning for a potential run-up.
That discipline is everything in these kinds of names. We appreciate you joining us for this deep dive into ONDS Holdings. Before we go, here's a final thought for you to consider. Given the stock's high beta nature and the sharp contrast between a harmless SEC filing causing a panic and the poorly timed insider selling by leadership, which data point is more critical to watch leading up to that January 16th investor day? Is it the technical support levels, or is it the actions of company leadership?